All right. What's up,
Yo,
Cody?
hey Mike.
So, this is Cody Romness with Allegiate Gyms in Southern California. And we thought it'd be helpful to have a conversation, Cody and I, about financing for small businesses, being that, and I'll let you talk about Allegiate, but being that you have successfully raised money for your company, you now have 3 locations, you're looking at a fourth. And
hmm
well, let's jump in and we'll talk a little bit. Let's get an overview of Allegiate first.
Yeah, so it's a group-based strength and conditioning concept, boutique fitness. So right in broader fitness, you've kind of got the big box gyms, 24 hours, LA Fitness, Gold's Gyms, and then you've got these boutique concepts. Some more popular, brands are Barry's Boot Camp or F45, or there's kind of a dime a dozen. There's so many boutique brands. But there's not anybody specializing in like true strength and conditioning, and so that's kind of our pocket. We're boutique. It's class based, but it's more like that former collegiate athlete sort of training experience. Higher quality sort of offering, kind of compared to some of the other stuff that's out there in the market. So we started with one location in Redondo Beach. We did that for 4 years. We opened our second location in Santa Monica, and then our third one in Century City. Made it through the pandemic, which was a pretty gnarly time to be in the fitness industry. We actually ended up expanding during the pandemic, which we could potentially may or may not want to talk about in terms of that. But that was kind of a cool, optimistic story when it was difficult. But anyways, that pretty much rounds it out. We do classes, we do personal training. We've got probably about 30 staff, mixture of part time and full time, and then 3 partners focused on the business.
Take us back to when you called your partner with the idea and he agrees to join and your other partner agrees to join. And now what? You guys specifically, did you self-finance at the beginning or did you go straight into raising capital?
We self financed at the beginning. So we had 3 partners. One partner put up the initial seed capital in the beginning to be able to buy the equipment. He had closed a deal in either investment banking or mergers and acquisitions, and he had some funding to be able to kind of kickstart it. And the deal was the other 2 partners, Tim and myself, would be sort of the ones actually in the day to day of operating the business of turning this into something that was profitable. And so, in those early days, that's how we funded a lot of this stuff. It wasn't a ton of dough. It was like 175K probably to get started. And then Tim and myself, though we didn't contribute directly to, say, purchasing equipment like capital contributions.
Sure.
As anybody knows, it's brutal to get a business started, especially in that first year. So I mean, I burned through all my savings. I went into credit card debt, and I'm not a guy that likes debt at all. And so we kind of have that whole story in terms of like, you know, how to survive in that first year of business
So you didn't
when you're building it out.
you didn't contribute actual capital, but you didn't take a salary, is what you're saying initially. You
Uh,
were
we we
living
we
off.
we paid ourselves, but it was the models and the projections of what we believe it or not, right,
Yeah,
were
right.
not on track with the actual reality of what it was. And then before we knew it, we were deep in it. And there's the thing is, when you're the business owner, there's nobody comes to save you. You have to save yourself. And so that was where we just had to really do some belt tightening and make some extreme lifestyle changes and hang on for a really long time in that first year to get the business to a point where it was paying us something that was like a decent living.
So one capital partner, 2 operating partners at the beginning is, I want to ask one other question with that. But is that still the structure now, or is the operating or is the capital partner more involved at this point now that you have multiple locations?
Yeah, the capital partner's always been involved. His name's Steve. He's always been involved, sort of in a strategic or like an ongoing phone call kind of basis, meeting basis. And very involved in terms of leading some of the investment rounds and things like that when it comes to talking about that stuff. But for the actual building of the business, that side has been Tim and myself, the 2 operating partners. Um, and all of the rest of our staff. But it's pretty much the same structure as it was when we founded the company.
Gotcha. So $175,000 initial investment buys one location. So I assume you go and you sign a lease, and then you sign a lease. Now you have to buy a bunch of equipment.
Yep.
This covers. Give us an idea of what that covers, other than the actual equipment for the gym.
Yeah, in brick and mortar, you've got your lease. So depending on what type of landlord you end up signing a lease with, there may be some personal guarantee that you have to make. At what amount, it's going to depend on kind of how the deal is structured, and then the size of the place and the type of landlord that you're signing with will also dictate certain terms. So you might find a Class A building, for example, that you think is going to be great, but if it's your first location, they're unlikely to want to take a bet on you because you really have no history or track record in terms of business that you can actually show. And the reality is most of these places go out of business, so they're wondering, are you going to make it or not? So we ended up finding a smaller mom and pop spot that needed some tenant improvements. So there's the TI in terms of a brick and mortar of stuff that you got to spend money on. So like, hey, you get the paint job? What are the bones of the building? Can you minimize the amount of TIs that you have to make this place look nice enough for your brand to be able to pull off? And then it's really your working capital. So, once you kind of spending the money, I always say spending the money is the really easy part. It's much harder to get people to spend money on you. And before you know it, you could be buying bells and whistles that you think you need and that you want to. And then you realize that, wow, we actually don't have that much capital to kind of run this business. So going into the working capital, saving some for your pre-launch, in our world, your pre-launch advertising campaign, so you can be able to start generating some real business before you open the doors. And that kind of rounds it out.
And you're also in Los Angeles, in the South Bay, your first location. If people who don't know and aren't familiar with Los Angeles real estate, the South Bay is, what would you say? I mean, it's probably top. I mean, it's one of the most expensive real estate, as far as LA is concerned, most expensive locations real estate wise in LA. So that was your first location.
For sure. Especially on the residential side, absolutely. On the commercial, there's some pockets that aren't as expensive as, say, like a Santa Monica or Century City or something like that, right? So it's kind of like, if you're not familiar with the South Bay, it's kind of like a suburb of LA, like a really nice suburb. And we ended up being able to find a deal at a spot that was like still, comparatively speaking to other things that are out there in the market, expensive, but for LA, it was a doable first location.
Right. Yeah. It's, and we'll put some, images of it too, because that location, I've driven by it a bunch of times. It's a cool spot. But when you moved then to Santa Monica and Century City, you expand from there too. So you had $175,000. So that actually, before we go into the expansion, what was the structure of your first deal? Talk about whatever you're comfortable talking about.
In terms of like the equity split and kind of between the founders and stuff like that. Yeah. So basically it was, we went into the business a third. So 3 founders, and we all own 100% of really what is zero at the time. Right. Because it's all idea. It's no actual business. But you have to have those important conversations in the beginning, to figure out, hey, if you're lucky and you get 10, 12 years down the road to build a real business, those hard conversations that you have in the beginning kind of, they set the equity split for, what's to come. So the main partner, or the capital partner, Steve, who fronted the money in the beginning, got a bigger chunk of the business for that contribution. Which makes sense. It's like, hey, you're the one putting in the money on the table. You've theoretically in the beginning got the most. You're risking the most. You've got the most to lose. Sure, I'm going to lose some years and of my career and stuff like that potentially if it doesn't work out. But it's not $200,000 out of my own pocket or something like that.
What does that look like? 40? Is that like 40, 30, 30 or something?
Yeah, it's probably 40, 30, 30. Tim and I own less than 30, so it's probably like closer to 25. and then there's been some dilution.
Yeah, I was going to say is that
Yeah,
post
yeah,
money?
because we've had more investors come in as we try to, open more locations, right? And so the capital that we get from those investors will go to opening new brick and mortar spots. So
And the structure of that. So the first offering you guys put out there, you put it out to who do you put it out to, and what does it look like as far as, so you have the three partners and you guys own 100% at this point, the idea.
mhm.
Now you're bringing in outside capital. Did you bring outside capital for the first one, or it was just Steve?
Nope, not for the first
Just
one.
Steve. Gotcha. Okay, so that
Yep.
sets that sets the base, and then his agreement, is it a and again, if you don't want to answer, don't. It's like if it's confidential, that's fine. But in
Sure.
some cases, there's an early lot of the money capital partners get like some kind of a first in first out condition,
Yeah.
or in the contract. Is there something like that written in, or is it simply split?
Yeah, no, there's for all of our investors that come in, I think it's like a preferred investor or something like that, is the term, where it's basically like anybody that comes in now would get paid out prior to the founders. So I think in terms of that initial capital investment, there's also like we ended up having to put a little bit more money in, so we took a small loan from Steve, which he basically is not going to get paid back unless there's a liquidation event, into the future. But basically, anybody that comes in now is put in front of the founders in terms of preferred sort of payout.
Got it. And
And
the structure
yeah,
is an LLC, or like an S corp, or an S corp or C corp?
we're an LLC.
LLC. So it's members interests, and then there's a preferred members interest, or preferred member. I forget how they different attorneys
Yeah.
word that differently, but it's basically a preferred interest or something, preferred member share for anybody that
Yeah, and
comes
then
in.
we do equity in the parent company. So it's the parent company of Allegiate, and
Got it.
as we raise capital, it's mostly from our a lot of our investors are our members, which are some of our favorite people to do because they've lived and they've breathed the product,
Right.
and the experience, and they get it more, and they're just so intimately involved.
I love
And
that.
so that money, it's awesome. That
Yeah.
money will go to opening new locations, but it's in the bigger picture score, because as we what an exit hopefully looks like for a company like Allegiate is we build this thing to a 10 to 15 unit sort of brand, where it's like three is relatively easy. It's actually, the reality is one is really freaking hard. It's why most of these businesses go out of business. Two is like, okay, maybe you're onto something. Three is like, all right, maybe you kind of figured some stuff out here and you got a real regional play. But from
Mhm.
like an exit and like a legitimate brand standpoint of like kind of trending into that mainstream, we talk about like that 10 to 15 location in terms of like regional scale, operational
Right.
scale. You've got some real revenues coming in at that point.
Right.
And our sort of thing with our investors now is like, hey, help us get to that 10 to 15 unit number. And that will hopefully be an exit for those
Yep.
investors.
I always tell the people that I help, and I'm working with now, that I always tell people, and this has been my experience over 20 years, is that it's, generally speaking, it's a 10 to 15 million mark where it starts to make sense for a private equity company or a consolidator to come in and pick you up. And it's
Yeah.
like, and I don't know what your revenues are per location, but assuming a consolidator looks at it, they're looking at, okay, it's worth our while, right? This is
Yep.
this isn't just three places in California. They're
Right.
multi-state. They have, yeah. And the interesting thing about you guys, or one of the things that I found in digging through the stuff you have online, was it's what I see is that your how I should ask, how is your online uh, like training program going? Because for me, that was really cool. I saw that as well. And I thought, well, this is something that obviously has legs way beyond physical locations, because it's a culture,
Yeah.
it's a philosophy. And
Right.
that was interesting too. So that's nice of you to give that to the um, investors, because a lot of people would take each individual location and say, well, this is you're in LLC one, you're an investor in LLC two, you're an investor in LLC three, and they kind of take a look at that, and which brings up a question of, how did you then structure as you did grow? We'll get into, like, now that starting off with your second location, So
Hmm.
you, how do you structure that going forward? Is it a valuation thing where the parent company, as it grows in value, it's just done on a valuation basis, or did you have to change the structure? Give me an idea how it looks
Yeah,
like
yeah.
location
So
two and on.
the first location was basically bootstrapped and self financed. The second location we did in equity round, and we used a convertible note. So some people watching this might be familiar with convertible note. I wasn't familiar with the convertible note, and my sort of paraphrase kind of working definition is basically you rate the issue that you have at an early stage startup is it's hard to put a valuation on the business. So with a convertible note, you can kind of kick the can down the road of putting a valuation on the business where it's like this much money gets you this much equity. You can move that
Mhm.
conversation down. You can secure some capital. The people that do the convertible note, they accrue interest, and then that principal, so to speak, that they give you plus the interest that converts to equity when you have your next like round. So for us, it
Exactly.
was okay. We do a convert, and we get the capital that we need to buy squat racks, rubber, et cetera, et cetera. We use that money, we deploy it to open the location, but it still hasn't converted to equity until we do that next round, which for us was location number 3. And when we did that, then officially their money converted, at a sort of
Right.
a better number because they were in sooner plus the interest, and that converted to equity. And then anybody else that started coming in after that was like it was kind of like a true sort of equity round, like a Series A or a
So
Series B and stuff like
location
that.
three was an actual just straight equity, no convertible note anymore.
Yeah, yeah.
Got it.
And for what it's worth, location number 2 was supposed to be Allegiate Century City, but the day we broke construction was the day the stay-at-home order hit LA. So we basically had to
Yeah.
shut that project down, sit on our hands for a bit, put on our optimist hats after about 6 months in Santa Monica, and we thought, well, we had to save business number 1, and then luckily we were able to do that. And then we ended up finding a place in Santa Monica because we were like, you know what, nobody's probably signing leases right now, and unfortunately somebody's lost their business. And my heart goes out to all the fitness. It's the numbers are disgusting in terms of like the amount of fitness businesses that are gone
Right.
as a result of COVID. But
Yeah.
on the flip side, the positive side for us was we found some really favorable times to sign a lease because nobody was signing a lease, and there was so much inventory due to people being gone. So we
Yeah.
had back to the financing piece. We had capital from Century City. We could move that over. We could open Santa Monica, and then we would do another round, which would end up being Century City. So there might have been some back end kind of like restructuring of the docs or something like that we had to just be honest about, like, hey, we're going to move this to this place. I can't remember if that was the point, or if that didn't really matter.
And that's like, well, circling back to what you said, you mentioned convertible note, and that's exactly, it's a debt instrument that converts to equity, giving you a lot of flexibility in the deal. And that's one of the things that I'm sure the advantages of having that set up that way was you can go. They also, there's another. It can be used for a variety of different ways. I've used convertible notes in various ways where it's a penalty actually, where it starts as debt, and it's only debt. But if you don't pay the debt back or meet the principal or the interest payments on the debt, it starts to convert and eat away at your equity. So there's
Interesting.
several different structures of that I've used them. I love them. I think they're the greatest thing. In fact, nowadays they have the Y Combinator has a thing called a safe agreement, which can operate just like a convertible note. But it's they basically Y Combinator basically made a standard agreement that gives you the flexibility to do what you're talking about, where it doesn't set a specific. I believe what it does is it basically sets a valuation, and then puts everybody in at a certain valuation, and then allows you to the flexibility to do whatever you need to do with that. But the valuation's a percentage, so it's not you're not if the valuation suddenly goes to from 5 million to 6 million, or 5 million to 3 million, you have a certain percentage with that, and you're not, so everybody knows what they have, and they're
Yeah,
pegged to a certain amount, yeah, at the beginning. But
that makes sense.
yeah, so then you got going into the so that's a great question about COVID. So how did you go in? So how much did you raise during COVID, and for your second location? So second location, Santa Monica. I remember you opened it during COVID, and
Yeah.
so you had to go out and raise capital during COVID from friends and family at that point, and
No, we actually
members.
we had finished the fundraising round prior
Got it.
to like COVID. So the money was in the bank, thankfully.
Right. Okay.
Yeah.
Yeah. Lucky. That's awesome.
Yeah.
And then
Seriously.
so you just had to open a location as fast as possible before you have to give it back.
Yeah, but yeah, basically. I mean, and the way you structure, those the agreements, and that's one thing. It's just like doing it legit, having a lawyer, having the paper trail, like doing all that.
Yeah.
Frankly, boring stuff, but like the really crucial, important stuff, just the pro stuff. Like be a pro about it, because
Yeah.
if something like that happens, you have to have those things in place so somebody can point to something. And
Absolutely.
my credit to my partner Steve in terms of the one leading those things. But yeah, that so we had the money in the bank from Century City, and we used that capital to open Santa Monica, and then we did another small round to open Century City when that one came time.
Got it. And so let's talk about the docs for a minute there. So you use a convertible note. Steve has some experience. Obviously, he's got a lot. He just made an exit and financed your company.
Mm-hmm.
So, and that's his background, my understanding. So then,
Yep.
do you go to an attorney aside from Steve, or is Steve sufficient? Does he have the docs? Do you guys also hire an attorney and get an actual Allegiate set of docs made?
Yes. Yeah. We get an attorney, but like anything we do, we're pretty lean. We're pretty frugal. So we find somebody off online or something like that. That's not like one of the big firms or something like that. It'd never be kind of how we would operate stuff. And then we go back and forth and we get those docs. And so I think in the beginning it's like okay, you send the pitch deck, right, which is your marketing material. You have some that tells your story, and then you get into some of the unit economics, and then you have a phone call with somebody. This is like the investor sort of life cycle, so to speak, at least ours.
Mm-hmm.
You have the conversation, you do some back and forth follow ups. They might ask for some due diligence stuff on X, Y, and Z. You supply them back with that stuff. You keep the conversation going, and then they're either in or they're not in. And then if they're in, then it's like okay, you send them over the documents, and what those are, just officially like putting down to paper, like hey, what are the terms of this? What does this mean? There's like I think there's standard stuff that you have to include of like hey, this is a high risk sort of investment or something like that. Just kind of like stock standard language. I'm sure it depends on like what state you're in, shit like that, which I couldn't really speak
There's
that
always
well too, but
there's always boiler. I do my own. I've done my own for years. I have. I mean, the last time I spent money on docs was years ago, and we spent quite a lot for one of our companies. Over $100,000 just to get our private equity to work with a private equity firm. So in other words, to do
wow.
an M&A thing. But that was the last time I really spent any money on docs, and I have an attorney who'll just look at it and kind of rubber stamp it. But there's always boilerplate language, like you're saying. And yeah, that's exactly right. You last time, and I say that to people too to let them know, because a lot of people get carried away with that. To me, the docs are the docs are just as important as you being able to describe the concept. I won't say as important as a pitch deck, because sometimes you don't even need a pitch deck, but you always need docs. They're gonna sign, and they're gonna wire you the money. They're gonna want something that you have to sign. So. It's important, but the good thing is, like I said, you got Y Combinator has a free one. There's a million templates online. You can go and like you said, you don't have to break the bank spending money on an attorney to get it done. It's fairly easy these days. When you and I spoke the other day, you talked about sort of the way you go about pitching, and you were talking about something how you look at each individual investor and sort of tailor the pitch to them. Can you talk a little bit about that?
Yeah. I'm a big fan in sales, really, and generally, of making it a conversation and making it much more of a dialogue and less of a monologue. I, depending on where people are coming from in terms of like sales experience, I think the initial gut reaction and visual we have in our head is like the used car salesman of like, oh, do I got a deal for you today?
Mm-hmm.
But that's such an outdated like like model of sales. And frankly, I even selfishly, I hope people keep thinking about it that way, because you're just going to clean people's clock if you like start getting deeper and looking at all the other sort of psychology behind it and the questions and all that stuff. So it's like really for us on the investment side is, and it's worked well for us thus far is, we basically send our deck, which is, a marketing material, deck that tells the story, right? Of like, hey, there's a bunch of templates and stuff out there of like what to do. But for us, it was like, all right, what's an executive summary of what is this thing? Very simple and short. So if nobody's ever come across it, boom, they have in one or two sentences, they know what they're doing, right? And then the rest of it is like, okay, what are the things that are important that would make this person think, wow, this would be worth my money, or wow, this would be a good investment for me, the investor. So it's not like what's in it for me, Allegiate, and framing it like why we're so great, but it's just trying to put it through the angle and the lens of like, tell your story in a way that's compelling for the investor, not necessarily compelling for you, but compelling for the investor. Put it in frame it in a way that's going to make them like, what's in it for me kind of thing.
Right.
And so sort of everything we do when it comes to that is framing it sort of that way. Right. So, timing aspect of it. Why now? Why is now a good time to do it? Why you guys, like why your team, or, what are the market trends that are going on, and just trying to give a holistic picture of all the components that make this idea of Allegiate a good thing to invest in. Cause it's multifaceted, right? It's all those different pieces. And then we'll send the deck over. In the best case scenario, the person, spends time, they read it, they have all the context that they need. And then we hop on just like we're doing right now. And we have a conversation, and we start with them, and we ask them to sort of lead it. It's like, hey, what,
You broke up a
said,
little bit
in
there.
a slightly different way, like what questions do you have and stuff like that.
Right. You broke up a little bit. There was a connection issue, but yeah. So you said, last thing I heard was you jump on a call like this and you go back and forth and you answer the specific questions. I think that's, yeah. And every investor has a different reason for jumping into a deal. And it's like, it might be the guy you see at the end of the year. If it's real estate, the guy just might have, you be part of a 1031, or he might want to, have something to do there. It might be somebody who's like, in your case, members. Everyone has a different reason. You told me a really awesome story the other day about a specific member. Are you comfortable sharing that? That was pretty cool, if you can. If not,
That's it. Yeah, I mean, that's an amazing story. We had a former member that his whole family came through and trained with us. His kids kind of like grew up through Allegiate, and now they're on to college and doing other things, and fitness is always a huge part of his life. And after he contributed and he decided to be an investor, he was on the phone, and I live by the beach, and I'm just like standing taking the call, looking out at the ocean, as he's like kind of telling me this stuff, and he's like, man, I'm not the richest guy in the world, but I got enough, and what I'm trying to really do with an investment like this is create generational wealth for my kids, and I'm just trying to set them up and do right by them. And I was telling you, Mike, on the phone, like I get shivers even just telling that story, but I'm like looking out at the ocean right now, and it's so heavy. It's heavy in a good way, but I think in the movies and stuff, it's like, oh yeah, you get the money, but it's like the other side, the darker side of that is like, it's a lot of pressure. You know what I mean? Like, and sure, like I've bet my life on this thing, 100% for the last 7 years. But then when you have other people like that are seeing you and believing in you, and they are going to contribute money, and they're doing it to try to create a big moment for their family.
Yeah.
Like it's a pressure. It's a great pressure. Like I need more pressure. That's good, because it's going to help me, go in the right way. But it's also just like, this is real life stuff. You're playing for keeps.
100%. And that's a great story, because it illustrates a point I like to make to people, which is you're not doing anyone, or you don't have to come to somebody with your hat in hand. In his case, he saw the concept. Now he's been, he needs a way to create generational wealth. He told you what he needed.
Yeah.
And it's a heartwarming story, and the fact that he trusts you is amazing. But that's a testament to your brand, and a testament to the three partners. I mean, the way you describe it, you have yourself, you have So not only are you a former athlete, but and qualified to train there if you wanted to, but you're an expert marketer. Your
Yeah.
partner is a former Division I strength training coach and athlete,
Right.
and your other partner is an M&A guy. So it's like it's sort
Yep.
of the dream team. It's and I say this because a lot of people are hesitant to ask, and sometimes I think that's foolish because people do need a place to put their money. Now,
Yeah.
in with regard to this guy, did you had you already pitched him, or did he offer it?
We this is a interesting circumstance. I was walking the beach with my wife on the way to get coffee, and we ran into him, and then we just struck up a conversation as he was on his way to go play volleyball, and we started talking, and
Wow,
I brought up the investment, and he was like, "Dude, I'm interested," and I was like, "Oh my gosh,
awesome.
that's amazing." Yeah, it's like so. It's also one of those things too. Like you never know who you're going to
Nope.
talk to or what's going to happen, and you got to find that right way to like not be the guy in the room that's always like, "Oh, here he goes again, pitching his business," right?
Right.
Like, but you also, if you never put it out there, you don't know if they're gonna. So can you kind of find that right sort of style and sort of way to kind of slide it in there where it's just true and authentic and it's part of the conversation, but it also potentially leaves a door open if that person wants to walk through it, or
Yep.
if it gives you a shot. And so it's one of those amazing moments. And then on the other side too, we've had an investor that was basically to your point, like the tax year was they were coming to a close. They
Right.
had an investment that didn't work out, and they needed to get out of that one and move it into something else so they didn't have to pay capital gains tax or something like that.
Mm-hmm.
And it was just like amazing timing, right? But it was still one of those things of like just having the conversation.
100%. Yeah, for me, it's always people always ask you, "Hey, what's going on?" or "How you doing?" And it's well, what's going on? I'm raising money. I'm out there raising
Yeah.
money again. And I'll scratch my head and be like, I'm out there raising money again. And it's a pain in my ass, but that's what I'm doing. That's what's going on. And it's like
Yep.
raising money for what? And it becomes a casual conversation, much like you probably had. But that's the reality of it. That's what I'm worried about. That's what I'm doing. So when you say it like
Totally.
that to people, you tend to get a lot more offers and people buying. So then the so you said that you kept with the convertible note structure going into the third century when you so first was South Bay, Santa Monica was next, then you go Century
Yep.
City, and
Hmm.
had you shown it like had you returned anything to investors at that time, or were you still raising off the future, the long term?
So all investing in Allegiate in the so far and for the foreseeable future has been the long term play of a bigger acquisition or an exit, and that would be the payback for investors. So more like a VC model and less of like a paying cash dividends model as where we are today, right? So we're very transparent up front with folks is like, hey, any money that's coming out of the business, we're going to put back into the business to try to open more locations
Sure.
because we're trying to build a bigger business and capital's one of those ways that we can just keep funneling that thing back into the business. So I think for people in their sort of investment portfolio where this sits is like a higher growth opportunity, and yeah, it's going to take longer, but it's also got the chance to be 10x or greater, depending on the timing and the market and the luck and
Right.
all those things that go into it when you have that liquidation event.
Right. So and those, in my experience, tend to be smaller. They tend to be smaller individuals,
Hmm.
smaller individual investments, like 50 to 100K, 200K from some, based on their appetite. But that's in your situation. What are you seeing? Is that what's your average person in for?
Yeah, we do
Average investor
50K min
contribution,
checks. 50,
50K
50K. Yeah,
minimum.
50K min checks.
Yeah.
Yep. Yep.
Yeah.
And then we've had some other folks that have gone more. And like if somebody wanted to do like split a 25 between multiple people where we still get 50, like we would still do that. But yeah, that's how we structured it so far.
Yeah, yeah, and that also makes for a better investor group too. I mean, it seems to me like you're creating something where you have um, there a lot of, let me ask, how many people, what percentage are actual members that have invested?
Um, out of the investors, it's probably 60 to 75% of our investor base are members.
Wow. That's awesome. See that? Yeah. That's
Yeah.
so then did it get easier as you went to raise money for the third location? Has it gotten easier for you guys?
Um, I feel like it's never easy so far. It's never been easy. We obviously have more things that we can show now, but the challenges become greater as well, right?
Mm-hmm.
So it's like, hey, we're potentially going to go to a new market for number four, and so yeah, we've got a bigger business, but there's still kind of a variable. And so, if you're just staying in LA and you've got that next obvious one, it's just a little bit of a different story. So I don't know that it's been easier. I think we're more experienced, and we have a much firmer grasp on and expectations wise on the whole process of things. But I always just get my mind right when you go into these things too. And it's like, I also like, we like to have an end date to these things. So it's not this never ending cycle, because it's emotionally a lot to be having these calls, and like, you got to be organized, and then
Yeah.
you're running your business the whole time too. Paul Graham talked about that. You're talking about VC, Y Combinator. Like, he talks a lot about that. He's like, do it in a season and sprint like
Oh
hell,
yeah.
and
Yeah.
get the money, close that thing. And then if people want in, just say, hey, we're not actively, but we'll keep your contact and we'll circle back next time.
It's a
Because if you
full-time
don't,
job.
it's just, for
Yeah.
sure, it's this perpetual, like, and it's the founders, the ones that have to do it, like,
Right.
you got to be the one on the phone, and
100%.
100% should be.
Right. And if you really want to make I mean, it especially, well, the good thing about you guys is you can have them, they're actually there in front of you sometimes. I mean, if it's 75% of your base of your members, which I think
Yeah.
is genius, but if not, I mean, it's dinners, it's late, it's going out late nights, it's going to, out of town to go see people, potentially there's a lot of it. I mean, yeah, when I would do it years ago, it'd be a full-time job for sure. So
Yeah.
do you guys have, aside from the friends and family convertible note group members in the LLC, have you done any institutional funding at all? Like not so much working capital lines or something like that, but just any kind of like institutional, like SBA loans, non-COVID or anything like that?
No, we haven't done any institutional capital. It's been, we're not opposed to it. I think if we, our bigger picture vision of, if we're going to open 10, 15 of these things in a year, that's
Mm-hmm.
going to take more than kind of like, bit by bit, member by member. And I think an institutional capital partner at that point is going to make sense. And, but it's just too soon, right?
Sure.
We've just got other things to figure out. And so that the pace of growth and expansion has been, pretty much in line with our ability to raise capital. And I think it's been a nice kind of balance. But then once we eventually get to that point where now we got to blow this thing up, then that's when that comes.
And what? Give me like an idea of what you define as too soon. Like what would constitute now you're ready for something? And when I say institutional, now we're talking like an angel or a VC or something like that.
Yeah, I think VC or like a private equity, I think in the fitness space is kind of more, at least some of the deals that we see out there. Basically, kind of the model that's already out there is you get to a proof of concept or proof of scale, and then
Mm-hmm.
you've got some VC that either want to franchise, or pardon me, PE that want to franchise this thing and blow it up bigger. And they're kind of just doing a little bit of different math of like, hey, how can we drive the cost down while still open? What's the market, what's the potential size on something like this. So that's kind of how we've always thought about like an institutional round, where they would come in, we would have an exit for our current investors. They would have a score, so to speak, and then the founders would stay on to sort of scale up the business and build it even bigger. But it's also, there's another model too where Allegiate's kicking off enough revenue, or pardon me, enough profit where we could self-fund some stuff as well,
Sure.
where you get 10 of these things. And if you're smart and you're frugal in the way that you operate it, you're kicking off a decent amount of cash, and you don't have to, and maybe you could use some debt too at that point, and you could open more locations without having to give up equity. And that's something that we've thought a lot about as well. But foreseeable future, it's going to be mostly equity finance.
How often do you guys take a look at that? Like, do you guys sit down on is there a board meeting, or how often do you guys take an overview look like you're describing now of the business and kind of the forward direction?
Once a year, usually in December, we'll have a sort of the partners will get together in person, and we'll do that. We'll kind of cover all things. But generally, looking back in hindsight, a lot of the decisions that we made in the beginning are pretty much the same things in the way that we think about it now. So, there's not really a need to reevaluate, say, capital partners, because it's like, well, we're not quite at that unit number, right? And like, it still just doesn't really make sense. But if we get to that part, then we get to have that conversation.
That's a testament to the design in the beginning. You don't have to make too many changes, but that's great. That's good. So I have a couple other questions here. So the the communications. So one of the things I always am curious about is, because the stories I can tell range from, like, the passive guy you talk to once a year, hey, how's it going, to the guy who calls you every week because you've got his 50K and that's his 50K and he needs to watch his investment, and he wants to tell you his life story every time he's on the phone. How do you do the investor communications now that they're members and they're carrying weights around in front of you?
Yeah. I mean, it definitely shifts the dynamic slightly. Like if we had a member and they were just a member, and then they now are a member investor, and there's just, you maybe spend more time talking to that person, listening to some of their concerns. Like a mentor I had, who was the manager of the band Incubus, always said in the record label stuff, like, money wants an opinion. It's like, if you give money, like, it comes with an opinion, and it should. And I understand that. Now, some opinions are more than others. And we have some investors that have invested, and I haven't heard from them since we had that investor call. Right. And that might be how they prefer it. And then other people are, they do want to check in. They do want to talk about the business. They do want to add their value. And we really like when somebody comes with, say a certain skill set or industry experience or something like that we can kind of use to help us on the business, and it's not just money. So that's always nice too. But it definitely changes. We haven't had the people that are like constantly calling me all the time.
Well, I imagine. Well, that's great. Good. I'm happy to hear that. But I imagine it's nice to be able to say, how do you help out with this? We'll just go tell your buddies about it, and tell your friends and family to come and join. That's how you help the place. And everybody has 100%. That. But that's cool. That I'm always curious about that. How people talk back and forth to their investment group and all that. Did you? I'm looking for a couple more here.
Yeah, and while you're looking, I've invested a very, very small amount in a friend's company who's in artificial intelligence, and it's been cool just to see him build his company and just kind of watch it, as a very small investor, but him being kind of the founder and CEO, and watching him build it. And his investor communications are much more hands-on, and he's much more, he's like wants to schedule calls and do updates and long emails in terms of kind of like updates. And some of that content's just awesome. It's like, I see it, and it's great because one, for his end, it gives you accountability to kind of put all that stuff down on a document and ship it out. And then two, for the investor, it allows you to see it. But at the same time, and I told him, I was like, look, man, like, I'm trying to build my own company. Like, I don't want to talk to you. You know what I mean? Like, not that I don't love you and I want to talk to you, but it's like, dude, no, like, I don't want to spend my time there. Right. So I'm a much more sort of passive investor than, But we were just transparent about that up front. And I think that was really important too, of like, how do you want to communicate? What's important to you?
You're saying you're that way with your investors, or he's that way with you? You ask your investors, how do you want us to communicate with you?
Maybe not so point blank in terms of that. I guess it's inferred a little bit, but I would say my other buddies on the spectrum of a higher level of communication, but we'll put it out on our like key pieces, key milestones, like, hey, we're going to move on this new location. We just did XYZ, and here's how we're thinking about it. like we'll make some of those big ones, but it's not a high volume communication unless our investors ask. Then we'll hop on a call and talk to them about that, right?
Gotcha. Yeah, makes sense. Yeah, and it's cool. When it comes to bringing a bunch of people on board, to one of the things that happens is you end up with the more people you have in an investor pool, it's almost like the more opportunity you get from that. Also, it widens your social circle in a way that a lot of people you don't know unless you know. But that's you know you're now on this crusade together, so to speak, or you're on this mission together. So you're all kind of together with something. So I wanted to, again, going back to the way you're doing it, it's like, it really, that's so unique that you have that many members. It's just, to me, that is quite the testament to the concept for sure.
Thank you.
Kind of generally speaking, what lessons would you say you've learned, um, pitfalls potentially, or just good lessons in general that you've learned from the cap raise portion of your operation?
I would say having a business partner like Steve, who's very, very skilled and experienced in this realm, has made everything a whole lot easier. So when some of those hard questions come that I personally wouldn't know really how to answer the right way, Steve's been very eloquent and able to navigate that. I realize not everybody's going to have that resource, but for what it's worth in Allegiate's world, like it's made a massive difference, and knowing how to structure those things and approach those. So I think some sort of baseline, if you don't have that, like getting some sort of baseline understanding of how these things work, and not just kind of glossing over the terms, and like, buying some of the books and just dive in and start, much like I learned how to copyright or write ads or stuff like that. Like just having a firm understanding of the overall process, I think is important. Um, I think on the pitching side, and the sales side is like, before we even have a call, for the most part, especially with the members, like they've already lived it, they've experienced it. And look, I'm biased, but we have a really dope product. Like we have an awesome product. We have an awesome experience. And I bet if we even had a piece of shit deck, like we could still probably raise some capital just because that product was really good and that experience was really good. So just remembering, like, look, you could have the sexiest deck in the world and have the most compelling story, but if your product's not good, it's going to be an uphill battle, I think.
100%. Yeah. Well, yeah. Yes, you're definitely fighting an uphill battle. And with you guys too, you can also put out a lower ticket. I mean, it can be a lower barrier to entry, 50K.
Yep.
That's not. I mean, that's this day and age. It's not really a lot of money for an investor. I mean,
Right.
it is. It's not insignificant, but it's
Right.
a comfortable amount to be able to go to the same place every single day and watch it's just, I can imagine those members are probably in better shape too. Right. I mean, like,
Yeah.
they're showing
Yeah.
up every day. It's just it seems like a good relationship for them. So now you are raising money now. You said that
Mhm.
you still have an offering open for a fourth location. What can you tell us about that?
Yeah, we're trying to raise about 300, 350 for that one. We're about 90% of the way there. I'm happy to say. We've had a lot of calls over the last, Q4 of 23 and into now. And and so we're trying to open what we think most likely is going to be Orange County. So we're in LA. That next market would be Orange County. It's not 100%. We haven't found a space or signed a lease or anything like that. But we like Dallas as well. We like New York as well for different reasons. I know they're kind of all over the place, but um, um, you know different things for different reasons. So
Sure.
we're narrowing in on having that capital, and then the plan is to open number 4 probably in Q2 of 2024, and then and basically for us, then pretty much the investment side kind of shuts down. We go and we do the hard work of building the real business. And ramping profitability and maintaining and elevating our current system in LA.
Hmm.
And just doing the hard work of proving the investment.
So cool. And that's great. And I imagine now you kind of have a template to set one of these up too. So when you jump into which is really interesting to me that you're raising them capital first. You don't have a location in mind yet, but you're saying you're putting it out there and saying, this is what we're doing. And in the offering, and you have obviously you can show what you've already done. That's a really interesting way to do it. And it makes sense for the investor too, because the moment, now is this cash that's actually a question. Let me stop there. Is this cash collected already, or is it committed?
This is committed. This is committed cash. So it's not wired money in the bank yet. But it is committed. And back to the question on the documents and stuff, like we had to talk with the lawyer to update the documents. So it's like it's kind of that dance of doing the sales calls, taking them, updating the docs, taking the time for that, and then sort of like sending those over once complete.
Yeah, and I'll explain why I've asked that, because a lot of investments they're called capital, or capital calls they call them, and or committed capital, where exactly like Cody just said, is you start off with an idea, you get a bunch of people to sign documents committing to the capital. Did you do the last two like this?
Yeah, well, the first one was the first one was a convert, and then the other ones were basically like true equity investments. But
and they were done committed. I was going to ask, have you ever had anybody not fund?
Knock on wood.
Yeah.
No.
Yeah, and nor have I. That's why I'm asking. It's almost never happens. It's a safe way to do it. It's typically, especially if you have a good investor group. But that's important to note. So you go out and you get everything committed, and this way they're safe with their investment as well, because it's not yet spent. But the good thing with you guys is you probably can round it up in about 2 weeks and then build out as quickly as possible, because you'll have all the money by the time you select the location.
Exactly. And it's just being transparent about the timeline and stuff like that. Hey, we're going to have docs firmed up by this time, give you about this time to do it. And then we're hoping to have, the wires complete by X date. And then everybody's on the same page in terms of that. And then for how we deploy that capital, right? Which I do love the vernacular of that. It's like deploying capital, it's like, it makes so much sense, but it's like, before I got into all this stuff, I'd just be like, well, what are you going to use the money for? Right. But it's, for our investors, it's like, we haven't necessarily picked the location, but it's not as important, because they're trusting us, the experts, to be able to find what's the fastest path to profitability, which one can you guys ramp this the fastest, and minimize your potential variables. And if that's OC, great. If that's New York, great. But, you have to, everybody's got to be on the same page in terms of why. And we just have to provide that reason as like, here's how we're thinking about it. But, that's why they're investing in us, because they're trusting us to make that good decision.
Yeah. Awesome. Yeah. And that is exactly what you want from an investment group, especially when you're now going to be on your fourth location. The concept's been proven. You want that flexibility. You don't want to be going back to them asking everybody's opinion. Right. Which is awesome. And and as far as nomenclature goes, dude, I still stumble over all these words, which is why I'm trying to give people case studies, and despite raising, quite a lot of money, it's like, I still don't know the M&A and the VC and the private equity. Every time I've gotten in the room with private equity guys, the language changes, by the way. It changes every fucking 5 years. You get them saying in 1 5-year chunk, and then the next 5 year, then the last time everything was the word market. They were throwing the word market around and I didn't understand what market was. So anybody out there who don't feel bad if you don't understand it. It's simple. You get a document. You give a document to somebody, they sign the document, they send you money, you put the money in your business, and you make them money. It's very simple. Just keep it, but you're right. There is.
Yeah, but to your point, because you get in the room with a bunch of really smart people, and then you're kind of like, well, they do this all the time. And then there's like this authority bias too, that you're kind of like having to navigate. And it can be a little bit intimidating when 100%. You're in that. But if you've gotten to the point where you're having these conversations in your businesses at this point, like, your intuition and your sort of business savvy and sense is something that you can really trust. And don't get too, I would say, in terms of like other things, like, don't get too wrapped up in the terms and thinking like that. And like, you can trust that thing, and just that intuition, and like figuring those pieces out, and then asking questions and being transparent, so that when you step into that thing, like, you're stepping with your full conviction, without just like not withholding those questions because you're worried about them thinking, you don't know X, Y, Z. Because I've asked a couple of those questions in some of those meetings of like, hey guys, I'm not the money guy here, but you said this, what does that mean? And then it's like ends up either being completely different, or somebody else is like, no, you're right, we should have said it this way. And it's like, okay, like I'm glad we asked, right?
100%. That's great advice, because it's very intimidating. Anything, I always joke around and say, you go and get an MBA so you learn how to talk. You learn how to speak with
Right.
an MBA. You really do. It's like you
Right.
learn the language. And the crazy thing is you learn the current language. Like I said, the language changes every few years, especially when different industries. I mean, Silicon Valley produced an entire new
Yeah. Yeah. I got you.
camera just messed up there.
Okay. That's all right. That's good.
You can get that there. Yeah. So anyway, but that was I got a backup camera. You see that?
Smart.
Yeah, I know, because that one does shut off with the heat. But anyway, we can kind of wrap up now anyway. But
Yeah.
the last thing I was going to say was so yeah, so you guys, again, you've got the dream team when it comes to a small business, right? You've got the operators, two very experienced uh, people in their field, and also in the actual delivery of what you do in terms of just former
Yep.
athletes. And right, you have an M&A partner who with skin in the game.
Hmm.
You have your own friends and family. I mean, I know a little bit about the investors in your company, and they're people who are related to you and your
Yep.
friends and your partners.
Yep.
Yeah, this is a no brainer investment for somebody. Like, well, who's ever wants to take down the 50K, and or whatever the 10% that's left of that offering. It's a no brainer. I mean, as far as a long term play, it's like, I would say anybody who's on the fence about this, in terms of my opinion, for what it's worth, it's a no brainer. You just wire him the money, or sign the docs and commit the capital,
Yeah.
and you'll wire the money when he wants it. But
Appreciate that.
do you have anything else to say, or anything else you want to cover?
No, man, I think that's it. Like, I appreciate the questions. I think it's a really fun thing to talk about. I guess I would, the last thing I'll say is, we kind of touched on it, but it's just like, if this is not your wheelhouse, it's okay. Like, you can just get in and learn it. Like, I personally had an aversion to spreadsheets, and I'd be like, and that's still not my
Mm-hmm.
weapon of choice in terms of like telling a story, so to speak. But like, you get into business and you just sit in these conversations and you have them, and you just get better and better and better and better. And then before you know it, like, we're having a relatively fluent conversation about funding businesses and converts and all that stuff, none of which I knew or looked into. Right. And I think that's the really fulfilling, cool thing about having your own business, and just constantly like learning on the go, and putting yourself in the mix. You just are like forced to learn these things. And
Absolutely.
and you learn them in a way that's like true learning. You don't learn them in a way that's like, that shit doesn't matter, but you think it matters, right? And I think it's this beautiful, if you're fortunate enough to have your own company, or like investing in something, or pitching companies, or even in this space, and you get the opportunity to kind of like have those conversations. I think just relish in it, because it's really fun. It's exhilarating. If you're doing something good, you're using money to help you advance that cause. And I think it can be a really, really cool experience to be a part of. That oftentimes I like to just sit back after, say, an investor call, and just kind of like sit in that energy and that stoke for a second,
Yeah.
because it's not just money transferring. It's not just opening locations. Like, there's the whole stuff that goes on, and it just like embracing that feeling and sitting in it. That would be one
Yeah.
other piece of advice.
It's a huge, yeah. Well, that's amazing. That's great, and it is a huge part of business. And I think, and my intention with making this video is really, it's going to help a few specific people. We'll put it up, and maybe other people will get helped by it too. But it's going to help a few specific people see a case study, right? Because the reality is, what I've realized is, you'll never beat. There's this thing called the growth plateau. It's an actual term, the growth plateau, and it's not necessarily defined specifically by a number, but basically the theory is, you're going to hit a certain number with a small business, after which it's impossible to exceed without an injection of capital. Now, there's obviously exceptions to this. This day and age, you have the digital entrepreneurs and stuff that we talked about before, where people are making all this money
Yeah.
online, and they can monetize these digital products and all this stuff. Okay,
Right.
that's not the norm. And I'm not sure how much longer that will be the norm, right? But the norm
Right.
is a company like yours that requires capital expenditures, right? You got to spend money on on stuff to expand, and you can only reach a certain point. In construction, that's about $1 million. Construction companies, I happen to know, $1 million in, you're going to sit in $1 million a year. If you can get there, you're going to sit there for 10 years before you actually exceed that. If you ever do at that point, you need a capital injection of some sort. So this will help those people who are sitting there saying, okay, maybe somebody has one gym and they're looking at like, where do I go from here? You know what that looks like. It's a modest income on one gym. It's a roller coaster ride. They have a cool concept, and or they have the ability to manage a gym really well. They have something, they know that they have an IP there. It might not be as thought out as yours or as well put together as your concept, but they have an IP. Now, what do you do with it? So it's almost a necessity at some point if you're going to be serious, and also if you're going to exit a business, right? Like if you actually are thinking long term and you just don't want to create yourself a job, this is a necessity. And
100%.
The last thing I'll say is what we've done is we've become so insulated from each other, and I think the pandemic was something that made us more and more and more insulated from each other. That people, what I'm finding out there now, the people I talk to, they're just hesitant to even ask or have these conversations with people about raising capital, which is why they're turning to those high interest loans that you find online, and it's really destructive to the business. So I think this case study's a service for hopefully they get something out of this, and I appreciate you sitting here and talking about it, because it's really interesting for me too.
100%, man. And hey, you don't ask, you don't get.
Exactly. Well, that's a good place to end. All right, brother. Well, thank you very much, Cody.
Well, thank you, bro. Thank you for having me on, man. I always love talking to you.
Yep, likewise, and I will talk to you soon, man.
All right, brother.